Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, share, and like buttons. Well, we have a special video for you here on Sunday night because of what's going on right now in the world. We have just big breaking news all over the place. Probably by the time you actually watch this, it'll be old news. They'll be onto 100 different things. But for those of you who haven't heard already, many of you have heard by now, on Friday, Silicon Valley Bank basically was taken over by the FDIC, and it's supposed to reopen tomorrow on Monday morning. It's the second largest bank failure by assets in United States history. Over 90% of the deposits were above the $250,000 FDIC limit, so they would have been considered uninsured under normal circumstances. We're going to have an update on what's happening right now in just a moment, but then we found out mere hours ago that Signature Bank has also been taken over by federal regulators. And so we have a second bank failure. This one had over $100 billion in assets. That's about half the size of Silicon Valley Bank. And so we have breaking news. How is the government going to react to this? What's going to take place tomorrow and the days ahead? So there's a lot to discuss. We're going to go through what's happening, why, and what it may mean for the future, and where all of this is going. Because for many of you that have been watching these videos, you know we've been talking about this for months on end. This isn't a new thing. This isn't unexpected. In fact, we just did a video on Monday titled, "This is going to be very bad," talking about the coming depression, talking about this exact same thing. This could be the possible Lehman type moment we've been talking about for months that was on the threshold of taking place. That remains to be seen. Maybe this is the Lehman moment would be a reference to the failure of Lehman Brothers in September 2008, which was seen as basically like the focal point of the 2008-2009 financial crisis. But it could also be more akin to the failure of Bear Stearns 6 months before, and they were acquired by a larger entity, and we didn't have the same crisis elements come out of that as we saw with Lehman Brothers, which was simply allowed to fail. So let's take a look at this article right here, because I think this gives a good overview in telling us exactly what happened with Silicon Valley Bank. This is from CNBC. It's titled, "Here's How the Second Biggest Bank Collapse in U.S. History Happened in Just 48 Hours." Because, guys, this took place very quickly. There were people who foresaw that this bank had issues. We're going to get into why there were some of those issues, because at the moment it doesn't appear that this has anything to do with fraud, but it has to do with something we've been talking about all year long. And there was a reason I kept bringing it up and kept bringing it up, and we're going to connect those dots in just a second. But this says, on Wednesday, Silicon Valley Bank was a well-capitalized institution seeking to raise some funds. Within 48 hours, a panic induced by the very venture capital community that Silicon Valley Bank had served and nurtured ended the bank's 40-year run. Regulators shuttered Silicon Valley Bank Friday and seized its deposits in the largest U.S. banking failure since the 2008 financial crisis and the second largest ever. The company's downward spiral began late Wednesday when it surprised investors with its news it needed to raise $2.25 billion to shore up its balance sheet. What followed was the rapid collapse of a highly respected bank that had grown alongside its technology clients. So to put this in perspective, this bank had, I believe, 17 branches. That's what I've heard. I don't know. I can't be sure if that's the exact amount, but it didn't have hundreds and hundreds of branches all over the United States. But it was the 16th largest bank by assets in the United States. And the reason was because of the clients that it cultivated over its history tended to be these Silicon Valley technology, biotech startups, and they nurtured relationships with venture capitalists who invest in those startups. They had a lot of add-ons and service that they provided to that community. So they catered their business toward helping that community. And in some cases, that included exclusive banking relationships with some of those startups. So the venture capitalists might give $20, $100, $200 million to a startup, and they would put it with this particular bank. And as you know, the FDIC insurance limits only go up to $250,000. So that means that anything above that was at risk of being lost. And as of December 31st, because this company was publicly traded, so they had to disclose a lot of these amounts, there was something like $172 billion in deposits at year end. And as we may read on later in this, over 40 billion disappeared within hours on Thursday afternoon, I believe it was. So this was happened very quickly. But let's read on a little bit more and see what we have here. So it says the episode is the latest fallout from the Federal Reserve's actions to stem inflation with its most aggressive rate hiking campaign in 4 decades. So this episode, they're tying this to, and we're going to read on, has a lot to do with the aggressive rate hiking campaign by the Federal Reserve. So for those of you that haven't been watching these videos in the past, I'm going to turn your attention to this Federal Reserve data right here. This is when they talk about the Federal Reserve, the Fed hiking rates. This is what they're talking about, the federal funds effective rate. Here's historical data going back to July 1954. We see up here in the late 70s, early 80s, we had rates that were 19, 15, 17%. So recently, as of February 1st, the rate was 4.57. So people look at that and say, well, what's the big deal? 4.57, certainly there's whole decades where it was higher than that. This shouldn't be a big deal. But when you look at the year-over-year percentage change of the same data, you get this chart right here, which shows that for decades, pretty much nothing happened, and then all of a sudden in the last year, we had this skyrocketing vertical chart. And I think that puts into perspective this right here, where it says the most aggressive rate hiking campaign in 4 decades. That's what caused this, because this bank was going out and they were buying bonds. They would get investor deposits. They would go out and get what they thought were safe, low-risk investments in government bonds that paid 1% or 0.5% or whatever they were. But as rates go up, the price of those bonds goes down. And the inverse is true. When the rates go down, the price of the bonds goes up. And so what happened is customers went to withdraw their funds from this bank. The bank is going to sell those bonds in order to raise capital. And as we see, that put them in a very precarious position. So let's read on a little bit more and see exactly what happened. So it says the ramifications could be far-reaching, with concerns that startups may be unable to pay employees in the coming days. Already on Friday, there were some companies where they didn't make payroll because the bank was closed. Venture investors may struggle to raise funds, and an already battered sector could face a deeper malaise. It says the roots of Silicon Valley Bank's collapse stem from dislocations spurred by higher rates. What we were just talking about is startup clients withdrew deposits to keep their companies afloat in a chilly environment for IPOs. That's initial public offerings. That's when you first take your company public and trade them on the stock exchanges. And private fundraising. Silicon Valley Bank found itself short on capital. It had been forced to sell all its available for sale bonds at a $1.8 billion loss, the bank said late Wednesday. And again, that $1.8 billion loss was the direct result of this right here. It was a direct result of Fed policies, which caused the value of those bonds to decline. And when they were forced to sell them at a loss, that's when they incurred the loss. Prior to that, it was just a loss on paper. But this goes on. It says, all told, customers withdrew a staggering $42 billion in deposits by the end of Thursday, according to a California regulatory filing. By the close of business that day, Silicon Valley Bank had a negative cash balance of $958 million, according to the filing, and failed to scrounge enough collateral from other sources, the regulator said. So guys, this is what happened. So they basically had a bank run. Again, this was not a normal bank that we would think of, like the place where we bank. It's just the community at large. And so you have people who have small accounts, your everyday people who have everyday checking accounts, along with local businesses. It's a reflection of the community. This was a bank that catered to businesses that had large cash balances. And when this happened, most of these deposits were uninsured. I've seen, I believe, 93% is the figure I'm seeing put out there. And so then you look at, okay, what were these used for? They were used for payroll, right? So in a lot of cases, for funding the operations of the business. So imagine you're running a business and, you know, of any size. If you run one of a small to medium size, you might have a million or more, far more than that, in cash just to meet payroll for each payday. The idea that you would be able to break that up, especially if you've got, you know, you need 20 million or whatever to meet payroll, you're going to break that up into these $250,000 chunks and among dozens of different banks. That's just not feasible for most businesses. And so what happens if you have a bank failure and those businesses lose that, everything above that $250,000 limit, and then they can't meet payroll? What happens if they can't pay their vendors? They can't pay their account, what they owe other businesses? Then that impacts those businesses, those employees. The business may go under. So you can see how this would have catastrophic consequences if that unfolds that way. Now we're going to get to news right now that they're saying at the moment that is not the case, that everyone who had cash at the bank, that all those deposits, even those that were uninsured, will be made whole. So let's look at this article from Zero Hedge. It's titled Fed Panics, Signature Bank Closed by Regulators. And we talked about that before. So here we have another bank here on Sunday night that has been closed by regulators. It says the Fed, the Treasury, the FDIC announce another banking system bailout. So this is an update from 6:20 Eastern Time. It says panic is finally here. On Friday, we said that the Fed will have to make an announcement before the Monday open, and we didn't have to wait that long. In fact, the Fed waited just 15 minutes after futures opened for trading to announce the new bailout, alongside even more shocking news. The Treasury announced that New York State regulators are shuttering Signature Bank, a major New York bank, adding that all depositors, both at Signature Bank and also now the insolvent Silicon Valley Bank, will have access to their money on Monday. And as we process the shock of yet another small bank failure, which makes JP Morgan even bigger, the Fed just issued a statement saying that to support American businesses and households, the Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. This action will bolster the capacity of the banking system to safeguard deposits and ensure the ongoing provision of money and credit to the economy. It says the Fed also said that it is prepared to address any liquidity pressures that may arise, which in turn has just unveiled the first bailout acronym of the new crisis, the Bank Term Funding Program, or BTFP. So this is details from the government. It says the financing will be made available through the creation of a new Bank Term Funding Program, BTFP, offering loans of up to 1 year in length to banks, savings associations, credit unions, and other eligible depository institutions pledging U.S. Treasuries, agency debt, and mortgage-backed securities and other qualifying assets as collateral. These assets will be valued at par. The BTFP will be an additional source of liquidity against high-quality securities, eliminating an institution's need to quickly sell those securities in times of stress. So in other words, as we saw with Silicon Valley Bank, where the depositors are withdrawing cash, so they go out and they sell these bonds they have, but those bonds had declined in value because of the rising interest rate environment. And so they had to sell them at a loss. So under this program, the government is saying, well, you could come get a loan from us for a year, eliminating your need to have to sell those bonds at a loss. This goes on. It says the Fed explains that the Department of Treasury will make available up to $25 billion from the Exchange Stabilization Fund as a backstop for the BTFP. And while the Federal Reserve, which was completely clueless about this banking crisis until Thursday, that's commentary from Zero Hedge, does not anticipate that it will be necessary to draw on these backstop funds, we anticipate that the final number of needed backstop liquidity to be somewhere north of $2 trillion. So what Zero Hedge is saying here is, a few days ago, the Fed, Jerome Powell, Janet Yellen, everybody in government said, everything's fine. Everything's wonderful. There's nothing wrong here. We're going to continue on our current trajectory because everything's fine. And now they're in this panic, introducing these new programs and saying, everything is going to be fine. Trust us, right? And they're going to offer $25 billion to stabilize, was it $18 trillion of deposits in the United States. And here, Zero Hedge is estimating that, well, you really need to make it about $2 trillion in order to do that. So we'll see. We'll see what happens as a result of all of this. Again, a lot of this is probably ongoing as I'm recording this now. There's new events taking place, and it's going to be an interesting week for sure. So this goes on. It says, more from the Fed. After receiving a recommendation from the boards of the FDIC and the Federal Reserve, Treasury Secretary Yellen, after consultation with the President, approved actions to enable the FDIC to complete its resolution of Silicon Valley Bank in a manner that fully protects all depositors, both insured and uninsured. These actions will reduce stress across the financial system, support financial stability, and minimize any impact on businesses, households, taxpayers, and the broader economy. In other words, what they're afraid of is that if they do not do that, tomorrow morning, hundreds of thousands, if not millions of Americans will be withdrawing cash from the banks. And especially if you run a business where you have cash levels exceeding that $250,000 amount, that you would be aggressively taking your money out of the smaller banks and putting it into these larger banks like JP Morgan that are considered too big to fail and that will be bailed out by the government in order to avoid a complete collapse. In which case, then you would see these smaller regional and local banks have 1930s Great Depression style bank runs that would destroy those banks. And again, We've been over this before. We had a FDIC video. I'm going to put a link to that video. I'll pin it at the top of the comments if you didn't see that. But we went over this before. So if you've been watching this channel for months, none of this should come as a surprise to you because we've been talking about it the whole time. But if you have less than that $250,000 limit, I'm fully confident that you will be insured against those losses because, again, no politician is going to tell your average Joe you're out of luck if you're under that limit when they can so easily just print the currency. Now, that doesn't mean there won't be a delay if you have your currency in a bank that fails, that there won't be a delay between when that happens and when you can access that, or that at some point, if the crisis is big enough, that the purchasing power of that cash will be the same as it was previously. So, but you won't be left with nothing, right? If you've got $100,000 in the bank, it's not just going to go to zero, I believe. But again, you do what you think is best for you. But if you have a business that's above those limits, or if you're an individual who does have above those limits, then I would be coming up with a plan B and a plan C and a plan D to protect myself. And we may very well see these limits rise. But again, this opens a whole nother can of worms because, well, how can they insure against all of these losses? Because the FDIC does not have the cash to be able to do this. The only way they could do it is to print more, and what problems does that cause down the road? We'll address that, hopefully, during this video as well. Anyway, it says the board is carefully monitoring developments in financial markets. The capital and liquidity positions of the U.S. banking system are strong, and the U.S. financial system is resilient. We've heard that before, haven't we? For those of you who were around in 2008. The depository institutions may obtain liquidity against a wide range of collateral through the discount window, which remains open and available. In addition, the discount window will apply the same margins used for the securities eligible for the BTFP, further increasing lendable value at the window. The board is closely monitoring conditions across the financial system and is prepared to use its full range of tools to support households and businesses, and will take additional steps as appropriate. And we know, would they be expected to say anything less? If you watch that FDIC video we went over, they had, I believe it was back in November, they did a war game of what happens when this very thing takes place. Right? What sort of messaging do we give, is what they said. How transparent do we have to be, is one of the questions they asked. Who should we be transparent to? And when should we be transparent to them? That's what they asked, which to me, I'm like, well, if you haven't asked those questions, you're not really being transparent. But anyway, they say here, well, this is from Zero Hedge anyway, he says, but wait, there's more. Concurrently with the Fed's statement, the Treasury also issued a joint statement with the Fed and FDIC in which Jerome Powell, Janet Yellen, Gruenberg, I don't even know who that is, all said that they are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. Now, read that line and you think back to that same FDIC video. And again, I'll pin it in the comments below. But what did they say in that? Well, the public has a whole lot more confidence in the banking system than those of us in this room do. And they all laughed, ha, 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 because in other words, we don't have confidence in the banking system, but we need to make sure that the public does, is what they said in that. Here they say this step will ensure the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. So again, they have to say these things. They're hoping that this solves everything, but hope is simply hope. Let's hope that they're right. I don't want to see huge systemic banking crisis right now. I don't want to see that either. But they have to act like everything's in control, right? Everything's fine. Don't worry. And they're just hoping, guys. They're just hoping. They have no idea. They're in over their heads. It says, additionally, the trio announced that all depositors at Silicon Valley will be bailed out, as will the depositors of New York's Signature Bank, which has just failed as well, and whose depositors will be made whole after invoking a, quote, systemic risk exception. It says, after receiving a recommendation from the boards of the FDIC and the Federal Reserve and consulting with the president, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all their money starting Monday, March 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. So, not really sure how that's possible, but that's what they claim. It says, we are also announcing a similar systemic risk exception for Signature Bank, New York. So, bank collapses, everybody's good to go, and taxpayers don't have to pay for it. Of course, the bank couldn't because the bank failed. Where'd it come from? Oh, well, we printed it, right? We just printed it. We had the power to add more ones and zeros and say it just didn't go away. Here it is. But of course, taxpayers do pay for it in the form of inflation, because you can't just simply print currency and not expect inflation. It says, we're also announcing a similar systemic risk exception for Signature Bank, New York, which was closed today by its state chartering authority. All depositors of this institution will be made whole. As with the resolution of Silicon Valley Bank, no losses will be borne by the taxpayer. Again, I don't know how that's possible. It says, while depositors are safe, creditors and equity holders are not. Shareholders and certain unsecured debt holders will not be protected. Senior management has also been removed. Any losses to the FDIC to support uninsured depositors will be recovered by a special assessment on banks as required by law. Finally, the Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks they have the ability to meet the needs of all their depositors. The conclusion, the U.S. banking system remains resilient and on a solid foundation, in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. And of course, as we can see from this weekend, those worked wonderfully, right? Those reforms, combined with today's actions, demonstrate our commitment to take the necessary steps to ensure depositors' savings remain safe. Now, this is from Zero Hedge. He says, translation, the Fed's hiking cycle is dead and buried, and I'm not so sure that that's the case. Because what he means is they're going to stop hiking rates, they're going to maybe even pivot and start lowering rates, open up this fire hose of currency printing and liquidity to try to save everything. Don't know if that's going to happen. We'll talk about that in a second. It says the Fed's hiking cycle is dead and buried, and here comes the next round of massive liquidity injections. It also means that the Fed, the Treasury, and FDIC have just experienced the most devastating humiliation in recent history. Just 4 days ago, Jerome Powell was telling Congress he could hike 50 basis points. And here we are now using taxpayer funds to bail out banks that have collapsed because they couldn't even handle 4.75% interest rates. And somehow the Fed has no idea. And that's exactly why, guys, it may be the case that this hiking cycle isn't dead. And there's a lot to unpack here. So if the Federal Reserve does a complete 180 and they start lowering rates, injecting liquidity, they go back to this quantitative easing program and they start buying up all these troubled assets, well, they lose all credibility, complete credibility. And of course, people who have been paying attention know that they lost credibility decades ago, if not at their inception. But the markets are going to say, I don't think so. And again, you have to think, okay, if they come out and they say, we're going to guarantee no depositor, any bank is ever going to lose their deposits, and we're going to backstop the whole U.S. banking system, well, that may prevent a run on banks. It may prevent the collapse of a lot of these banks. But at what cost? At that point, those who hold U.S. government debt instruments might sit around and say, so you've got 31 trillion plus in debt. That's the national debt, and you're just going to print currency to make all these depositors whole so that they don't lose anything. And I'm starting to wonder if you can pay back all of that debt, because every time we turn around, there's a new crisis, whether it's Ukraine or virus lockdowns, all these programs where you have to spend 100 billion here, 100 billion there, $1 trillion there. Is this ever going to get paid back? And then they start dumping all that government debt because they don't want to touch it. And then we have the United States doing what Japan has been doing, and we just talked about that on Wednesday with Japan. Japan has been buying back. It issues these government bonds, and then their central bank goes out and buys the bonds to prevent the interest rates from going up, because if the interest rates go up to their true market rate, the government will go bankrupt overnight. And so they're buying this stuff up. What are they buying it with? Well, they're just run the printing press and print yen, buy the bonds. Everything's going to be wonderful, right? Well, then the purchasing power of their currency goes to zero. People lose faith in that. So are people going to lose faith in the Fed, or are they going to lose faith in the U.S. dollar? That's why we've said for months now, there are only two options for the Fed and the U.S. government right now. Option number one is a repeat of the Great Depression 2.0, where you have bank failures, massive job losses, bankruptcies of businesses, and this prolonged period of pain. Or you have Weimar Germany hyperinflation, and the U.S. dollar just loses its purchasing power at a rapid rate. And if you think, well, yeah, we've been seeing that, Britt, for a couple of years now. Every time I go to the grocery store, the prices have gone up. No. You'll be going to the grocery store in the morning, and then by afternoon, the prices will have changed. That's the type of hyperinflation we'll be talking about on a daily basis. If people lose faith in the ability of the U.S. government to pay back its debt. So they're stuck in this can't-win situation. And so, what does all this mean for tomorrow when the markets open? I have no idea. I would be lying if I said, well, this is what's going to happen tomorrow. I have no idea. And again, a lot of what I've said now is probably out of date before I'm even able to upload this video. But regardless of whether there's a panic tomorrow or what the government has just done calms everyone's fears and everything's fine, know that that will only buy us a little more time. Eventually that panic will come back. There will be another failure a week from now, a month from now, 6 months from now, because those two options are the only ones we discussed. And it will be interesting to see whether Zero Hedge is right here. Are they going to do an about face? Is this the end of the hiking cycle or not? Because there was another something we read in one of those stories about JP Morgan would get bigger as a result of these failures, right? So who owns the Federal Reserve? It's not a federal agency. It is a private, semi-private entity owned by the largest banks. So JP Morgan, Goldman Sachs, Bank of America, Wells Fargo, these big banks, they own the Federal Reserve. It exists to serve their interest, not the interest of the American people, not the interest of the world at large. They exist to serve the big banks. What would serve the big banks better them bankrupting all of the small, mid-sized regional community banks, right? And having them, everybody go, I'm scared to have my money at the small bank. I need to move it to JP Morgan, to Wells Fargo, to Bank of America. And they move all of their deposits to those places. And what better setup for the rollout of central bank digital currency, which, while some people say it's going to cut out the banks because your account would be directly with the central bank, keep in mind it won't cut the banks out altogether, because the central bank will just be basically the clearinghouse for all of this stuff. You're going to have to have point of sale set up at businesses throughout the nation. You're going to have somebody making loans to businesses, for new homes and cars. So somebody's going to have to do that. I doubt that's going to be the Fed. It's probably going to be the big banks. And what better way to roll out this than the crisis we've been saying is going to come? All these bank failures. Oh, if we only had insight into what was taking place. Well, if we had central bank digital currency, we would have known what was happening at Silicon Valley Bank before all of this got as bad as it did. We would have known what was happening at Signature Bank. We could have prevented this FTX, that whole fraud. That would have never happened. And people will go, yeah, that makes sense. And you want to know that your deposits are safe. And where could they be safer than with the government, where we had the ability to print and make you whole? We can't go bankrupt. We're the government, right? That's what they'll tell you. And then, oh yeah, while you're at it, or while we're at it, you go claim that account. You go claim your Fed wallet, and there's $10,000, $20,000, $50,000 waiting for you. All you have to do is go claim it. And once enough people do that, they'll get rid of cash altogether. All physical cash will go away. And the only thing you'll be able to buy and sell with is the central bank digital currency. And once people trade their freedom for that promise of security, they will be in a cage. They will be trapped. And we will all be Canadian truck protesters who could have our whole life turned off, our economic life just simply turned off by the flip of a switch. So, guys, I wish I had better news. maybe I'm wrong. If you think I'm wrong, leave it in the comments. Let me know. But I think that's where we're headed with this. We're headed toward a crisis. We've been saying all year. We've talked in all these videos, and I'm gonna pin at the top of the comments these videos, because again, this was all foreseen. We talked at the beginning of the year about the number one most likely event for the year ahead that would set the stage for the fulfillment of Bible prophecy, the rise of the Antichrist, and these mark of the beast technologies would be a global depression. We talked about that. We've talked about a global depression with a financial crisis, and a financial crisis meaning events just like this, where you have a major bank failure and runs on banks. So people were lined up outside some of these banks on Friday and yesterday. There will be some people lined up at banks tomorrow, no doubt. But this is what we were talking about. We talked about just on Monday, this will be very bad. And there were some people that emailed me and said, I can't believe you're putting up, well, this chart right here. That's taken out of context because the starting point was 0, right? or the starting point of the rates was close to 0. And so, of course, it's going to be this large percentage. But, of course, you can't do that. You can't change rates so violently in a year and not expect what just happened to happen. You can't expect that. This was all foreseeable, and we've been talking about it all year. Back in November, I did a video titled, I Was Wrong, because as many of you remember, back in the summer, I was saying that an event like this, and again, this may not be the Lehman moment. It's pretty close to it, and we're going to find out this week if it is or not. But I thought this would happen back in November, and I said by November 1st, something just like this is going to happen. We're going to have a Lehman moment. Something's going to break because of this dramatic rise in rates and all the other things that were going on. And that did not happen. And I said, I was wrong, but The reasons I stated that, those underlying reasons have not changed. So I still expect that thing to happen. I was just wrong about the timing of it. And here we are, March 12th. So let's see how well I can do my math here. It's been a long day. 4 months ago, a little 4.5 months ago. So 4.5 months later, here we are, and it's happened. So guys, expect that a lot of the other things that we've talked about are going to happen as well. That should show you the credibility we have here on this channel of what we've been saying. And again, we'll pin those videos below because I'm not afraid of what I've said in the past and you going back and holding me accountable for it, because, you know, we need to know where things are going. And we know where the Bible tells us that things are going. The Bible tells us right now that the stage is being set for Mark of the Beast technology to be rolled out. And I believe central bank digital currencies are going to be on the other side of this massive global depression financial crisis we're going to see. And so, guys, I don't want to make this video any longer than it has to be, but tomorrow is a very busy day, so there won't be a video at the normal time on Monday. We'll just have to see how things develop. So we are set to move, scheduled to move this weekend. So there's going to be a lot going on. Not sure what the video schedule will be like this week, but there will be videos this week. Next week, probably not, unless there's just some catastrophic breaking news, in which case maybe I'll just talk on my phone with a bunch of moving boxes behind me. I mean, you're used to this closet, right? And that's the reason I'm not going to be able to have videos next week, is because, so in this closet right here is a door, and that's the door to the attic where all of our stuff is that has to come out to go to the new house. So I'm going to have to break down the computer and the microphone and the webcam, all that stuff that's in here, in order to get that stuff out. So I won't have that ability to make these types of videos, but if we have to, if something out there just needs to be addressed, I'll find a way to make it happen. So, and then hopefully, God willing, week and a half from now, I'll be set up at the new location and we'll be back to regular videos. So probably be a little while for the next couple of weeks, but in the meantime, let me know, what are your comments? What do you think about all of this? Like, what does all this mean? What's going to happen tomorrow? What's going to happen in the week ahead in regard to this banking crisis, these bank runs? Because we're seeing that on a miniature scale right now. What does all this mean? So let me know what you think. Leave your comments below. Make sure to like and share this. And God willing, I will see you sometime in the next couple of days. I have no idea when, because the schedule is so crazy this week. But God willing, I will see you again soon. Until then, bye. If you want to learn more about the end times and Bible prophecy, make sure to sign up for my free monthly newsletter and get your copy of my free ebook, 7 Signs of the End Times. Just follow the link in the description to get your free book. Also, make sure to check out all of my books. Just look up Britt on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.